FHA, VA, USDA, conventional, all the home buying jargon. What does that mean? Well, I am going to tell you what it means today. Hello, this is Belinda, and I help people build generational wealth with real estate. So today I am going to talk to you about the four main type of loan, and I am talking about the traditional lending when it comes to mortgage. So there are three programs that are government backed, and then there's one that is just solely private. So the three government backed programs are FHA, VA, and USDA. FHA stands for Federal Housing Administration, and that type of loan has a different, so each type of loan has a different type of requirement, and especially when it comes to credit score, when it comes to your debt to income ratio, when it comes to the usage of the house that you are purchasing. But you need to know those differences because some of them have higher income, not income limits, but loan limits, and then others have lower loan limits. So basically, the loan limit is the amount that they allow you to borrow. So it still is within a bank. You still are doing the transaction with the financial institution, because it doesn't necessarily have to be a bank, but the financial institution. But it's government backed, so they have different rules and regulation when it comes to the type of loan. So let's start with the FHA, which is one of the government backed loan program. So FHA, as I say, stands for Federal Housing Administration. So with this type of loan, the minimum credit score requirement is 580. And I said in one of my videos that when you have a lower credit score, you have to pay for it on the back end because your interest rate will be higher. But that's the minimum that it requires, and the minimum down payment that they require is 2.5%. So if you have a credit score of 580 and you are intending to buy a home and have saved up 3.5% and plus closing costs, of course I have to always talk about closing costs, you are basically able to purchase a home. But you can only purchase it if it's your first residence. So you cannot purchase it for, let's say, if you want to have an investment property or your second home or vacation home or things of that nature. You will have to live in that property if you purchase with a FHA loan. And then with a FHA loan, putting 3.5%, so you will have to pay a premium mortgage insurance for the life of the loan unless you refinance later on down the road. But this is basically what you have to do. So that's number one, FHA loan. So second one is a VA. VA stands for Veteran Administration, and very few people qualify for that because VA, as the name implies, is for veterans. It's for those people who have worked in the Army, in the Navy, in the military. That's a program that is targeted for them and their spouses. Just like the FHA is government backed, and the requirements also are quite different. They're quite different in the sense that you will have to have a minimum credit score of 580, I believe it's 580, and use the property for use it as your residence. So same thing as FHA, you cannot use it as a second home, a vacation home, or an investment property. If you're thinking that you can put some renters there and then collect some money at the end, no, you will have to use that property. But the great thing with a VA is that there is no down payment requirement. But as I said during one of my videos, the less money you put up front, you will have to make up for it for your mortgage. So it's always a good idea to have some money saved up. But there are also some other programs that are available where you can use those down payment assistance, or down payment, not only down payment assistance but also assistance for closing costs, because you still have to pay for closing costs even if you qualify for a VA loan and bring basically nothing as a down payment, but you still have to pay for closing costs. All right, so the third option, when it comes to government backed loans, is the USDA. USDA stands for United States Department of Agriculture. So this loan is typically given to people who are living in rural areas. And rural areas are defined as areas that are 30 miles or more away from the city limits. So, AKA the country. So these loans are very similar to the VA in such that it offers 100% financing, so zero down payment. And the minimum credit score, I believe, is 580 as well for this type of loans. And it should only be used for also your residence. So you have to reside in that property. You cannot buy it for as an investment property. You cannot buy it as a second home. You have to live in that property. And with USDA loans, the thing about the USDA loan, especially in rural area, they really want to encourage people to live in rural area. So sometimes you even have like brand new homes that need to be built from the ground up, and then they can also offer 100% financing on those. I personally, I like living in a rural area. It's just it's different. It's different from living in a city. It's quiet. You have cleaner air. You have access to farms. So it's always nice. I mean, it depends, on what you really want. But these three different programs are government backed, and they have those requirements. And then the other one that I'm going to talk about, the final, is the conventional. Conventional loan is a type of loan that's a private loan. So the requirements are different for those. You require a minimum credit score of 620, and you can use it not only for your residence. You can also use it for if you try to buy an investment property, if you're trying to buy a second home, if you are trying to buy a vacation home. You can use conventional loans. And with conventional loans are good in such a way that they're not loan to value, but the loan limits are a little more generous than the government programs because they're more private. So they have a different ways of looking at, let's say, student loan. When you purchase a home with the government program, they look at student loan differently. The way that they use student loan in debt to income ratio is a little differently than what conventional uses. And then also, when you have a conventional loan, the minimum down payment is 3%. However, you would be charged a PMI until you reach, I believe, 10% of the 10%. When you have a 10% value of the property, when you make payment, 10% of that, then that's going to dissipate. So this is the wonderful thing about conventional loan. And then you have also lower cost when it comes to closing cost. There are just less items as opposed to an FHA or VA or USDA, because the government program tend to be a little more rigid, especially when it comes to appraisal, when it comes to inspection report. They want your house to be one where they find that it's a good investment. But when it comes to conventional, since you can purchase it as a second home or an investment property, you can put your own money and then rework the house, renovate the house. So they are different. All right, so I hope that's been very helpful, and I will ask that you comment, that you share this video if you find it helpful, and that you subscribe to my channel so I can give you more information. All right, so this is Belinda, and I help people build generational wealth with real estate. Talk to you later.